July 16th, the market update desk with Scott Riley, brought to you by Mortgage One. So, starting off today in the green, which is a fantastic thing. Now, a lot of that is buoyed by yesterday's speech that Chairman Powell gave at the Economic Club of Washington, D.C. Now, while Chairman Powell didn't say anything groundbreaking, he did sound more confident on his belief that inflation is heading towards their stated goal of 2%. He also indicated yesterday that the last three readings give him much more confidence that they are on that path. So, what that tells us is the Fed is really looking at these super core readings of a 3 month and a 6 month annualized rate. And if we look at that, we're not far off their 2% goal. We're on that trajectory. Powell also brought up the employment side of their dual mandate. Remember, rate, maximum employment, and 2% inflation. And he showed that mandate, how he is watching very closely the employment numbers, and if there's unexpected weakness in the labor market, which we contend that it's not unexpected, that it is there, that they would lead to cuts sooner and larger than what they are, that they're portraying out there. An interesting thing is when asked what keeps him up at night, he quote said, is cutting too soon and inflation coming back versus too late and causing recession. Now, bottom line, he's moving towards that more dovish camp, and he would like to cut, but it's really going to be a question of how much and when. We also heard more positive remarks from San Francisco Fed President Mary Daly, who's definitely more on the dovish side. Now, she's a voting member, and she is confident that we're closing in on that 2% inflation goal, but she does want to continue to see more traction towards that in the positive range to get to that 2%. Now, remember, next week's a very big week. I know we say that a lot, but there's a couple key potential pivot points next week. One of them is going to be very closely watched QCEW for quarter four. That's the quarterly census on earnings and wages for Q4 of last year. Now we're looking at potential revisions to the employment data that the BLS gave us, of potentially upwards of 500 to 525,000 jobs on the downward revision. Also, we're going to get the June core PCE reading. Those are very key pivot points that could, or I should say potential pivot points that could move the Fed sooner and to more velocity towards rate cutting. Currently, the market is pricing in the probability of a rate cut as follows as we're going through here. There's a 7% chance of a quarter point cut in the July meeting, but there's a 100% chance of a 25 basis point or quarter point cut in September. And now we're up to a 7% chance of a half a point cut. The market's also pricing in potential cuts for November and December. So what we're seeing is the snowball effect of what we've been talking about with the weak jobs, weaker GDP growth, and higher unemployment, sort of pushing the Fed into this position of they can't wait too long to cut. And if they do, that's going to be a detriment to the economy and flip us into the start of a formal recession. We know that we're already statistically there with the SOM rule, but the media is going to start to move now that if we move too late, it's not going to be to the economic benefit. Retail sales came in today, and it was a higher number than what the market expected because of a revision. Now, the June stayed flat at 0% growth for retail sales, which was weak and in line with the expectations. However, the May reading was revised higher from 0.1%, so 1/10, to 3/10, so a tripling revision upward. Now, this showed a stronger retail sales than originally anticipated. Additionally, the headline reading was dragged down by weak automotive and gasoline sales. The core reading, which gets plugged into GDP, rose 9/10. This was much stronger than expected, and we're going to really need to see what Q2 GDP numbers start to come out And with the next month, remember we get the first, second, and final look readings. But with potential core retail sales increasing, could put some upward pressure on higher than expected GDP, which the bond market really isn't friends with. Now, Peter Bookvar, who's a very known economist, provided some color on the consumer as he listens to hundreds of these earnings calls that are going on right now with earnings season on Wall Street. With retail sales, they're indicating that only a portion of consumer spend that is doing well comes from the higher end. That the majority of the higher spend in retail sales is coming from the higher end. The lower to middle income consumer is stretched and is extremely value conscious and focused on needs rather than wants. So this upper end is still spending, while the lower end is very constrained. The cash freight index came in for June, showed shipment components of freight fell 1.8% in June to a 4-year low. So maybe definitely seeing weakness in shipments also. Really interesting on how consumers are needing, consumer buyers, that is, are needing education on down payment amount requirements. The latest Fannie Mae study showed that most consumers don't even know what the minimum is that they need for down payment. Only 10% of buyers knew that you could buy with as little as 5% down on a conventional loan. And the median amount of people think you needed 15 to 20% for down payment. So part of our job is helping people understand maximizing what their budget will allow for down payment and mortgage payment. So we run through all that with our consumers. Technicals today, we're down a couple ticks on the 10-year bond. Mortgage-backed securities are slightly in the green. Those are both good things. As we continue moving through the week, let's see if we can hold those numbers, especially on the 10-year bond, keeping it below 4.2. I think we're at 4.18 right now. If we can keep it below 4.2, that's going to be a very good sign. Give us a call. We'll help explain more, and we'll help you get approved for your mortgage and communicate and use our relationships in the market to help get your offer accepted. Give us a call, 616-293-2189.